Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of Liquidity Ratios Explained, a practical guide to measuring financial health. Quick ratio calculation example. The quick ratio sharpens the focus by excluding inventory and other assets that might take longer to convert into cash. It emphasizes assets that are truly liquid. Here's how to calculate it. Find current assets. Start with total current assets from the balance sheet. Subtract inventory. Adjust the total by removing the value of inventory and other less liquid current assets. Identify current liabilities. Use the same current liabilities figure as you would for the current ratio. Apply the formula. Quick ratio equals current assets inventory divided by current liabilities. Example. A company has $150,000 in current assets, $50,000 in inventory, and $100,000 in current liabilities. Substituting these numbers into the formula. Quick ratio equals $150,000 $50,000 divided by $100,000 equals 1.0. Interpretation. With a quick ratio of 1.0, the company has just enough liquid assets to cover its short-term obligations without relying on selling inventory. This level is considered acceptable in many industries but could raise concerns if the ratio dips below 1. This ratio is particularly helpful in industries where inventory is hard to liquidate, as it gives a more realistic picture of immediate financial stability. Calculating the cash ratio. The cash ratio is the strictest liquidity measure. It only considers a company's cash and cash equivalents, like marketable securities, when assessing the ability to pay liabilities. Here's how to calculate it. Locate cash and cash equivalents. These numbers are typically separated out on the balance sheet. Identify current liabilities. Again, use total current liabilities from the balance sheet. Apply the formula. Cash ratio equals cash plus cash equivalents divided by current liabilities. Example. A company holds $70,000 in cash and cash equivalents, and it has $140,000 in current liabilities. Using the formula gives cash ratio equals $70,000 divided by $140,000 equals 0.5. Interpretation. A cash ratio of 0.5 means the company has only 50% of the cash needed to meet its short-term liabilities. While a low cash ratio isn't always a problem, especially if the company has strong receivables or dependable inventory, it signals less immediate liquidity. When is it useful? The cash ratio is often used in risk analysis. It's critical in situations where a company must meet obligations quickly, such as during economic downturns, unexpected lawsuits, or emergencies. It's also useful in industries where holding large cash reserves is standard practice, like banking or tech startups. Understanding how to calculate and interpret these 3 liquidity ratios gives you a more complete picture of a company's financial readiness. Each ratio serves its own purpose, offering unique insights into short-term stability. By using these tools, you can make smarter financial decisions backed by data. Analyzing liquidity ratios. Liquidity ratios are more than just numbers. They tell a story about a company's ability to handle its short-term financial obligations. Proper analysis of these ratios can help interpret a company's financial health and highlight areas of attention for management, investors, and creditors. In this section, we'll focus on interpreting the current ratio, quick ratio, and cash ratio to gain a practical understanding of what these numbers mean in real scenarios. Interpreting current ratio results. What a high or low current ratio means. The current ratio is often seen as a quick check of financial stability. It compares a company's current assets to its current liabilities. But what do the numbers actually tell us? High current ratio, above 2.0, a high ratio suggests that the business has more than enough assets to cover its debts. On the surface, this is reassuring, but it could also be a sign that resources aren't being used effectively. For example, excess cash could be better invested in growth, or idle inventory might be tying up funds unnecessarily. Low current ratio, below 1.0, a low ratio means that liabilities outpace assets, which could indicate trouble in covering short-term obligations. However, context matters. Some industries, like retail, often operate with lower current ratios due to fast inventory turnover and consistent cash flow. In other cases, it may signal over-reliance on debt or poor cash management. Think of the current ratio like a first impression. It gives a general idea of financial stability but doesn't tell the entire story. Always pair it with deeper analysis to understand whether the number reflects efficiency, caution, or potential risk. Significance of quick and cash ratios, how they correlate with business risk. The quick ratio and cash ratio offer more refined insights into liquidity, often serving as red flags for higher business risk. Quick ratio and business risk. The quick ratio excludes inventory, focusing only on the fastest to liquidate assets, such as cash and receivables. A quick ratio below 1.0 suggests that the company may struggle to pay short-term debts without relying on selling inventory. This could be risky for businesses in industries with slow-moving goods, like manufacturing. On the flip side, a high quick ratio signals strong liquidity but might also imply underused resources. In industries prone to sudden challenges, such as tech startups, the quick ratio serves as an early warning system. A drop could mean trouble is ahead, prompting managers to secure additional liquidity or tighten expenses. Cash ratio as a measure of immediate risk. The cash ratio takes a stricter approach by using only cash and cash equivalents to evaluate liability coverage. This measure is particularly relevant in volatile industries or during uncertain times. A cash ratio above 1.0 is uncommon but reflects extreme financial caution or preparedness. It's often a sign of a company that can weather immediate financial crises. A cash ratio below 0.2, however, might raise eyebrows for creditors. It suggests the company could face delays meeting obligations, especially in emergency situations. For businesses in industries like retail or hospitality that rely more on receivables and quick turnover than high cash reserves, this may be less concerning. Together, these ratios provide a layered understanding of liquidity and risk. If the current ratio is the big picture, the quick and cash ratios are the fine details that help identify vulnerabilities more precisely. Understanding and balancing these numbers is key to maintaining financial stability while minimizing risks. Industry comparisons. Liquidity ratios are most meaningful when viewed in the context of industry norms. Comparing a company's ratios to its peers helps gauge how competitive it is in managing short-term obligations. Without this context, you're only getting part of the picture. Benchmarking against peers. How do you decide what's a good liquidity ratio? That depends heavily on the industry. For example, an e-commerce company might comfortably operate with a lower ratio because of fast inventory turnover and predictable cash flow. In contrast, a construction firm may need higher ratios because of project unpredictability and longer payment cycles. To set benchmarks, identify direct competitors. Look for companies of similar size and business models in the same industry. Use industry averages. Many financial data providers publish typical ratios for specific industries. These averages give you a yardstick for comparison. Consider regional factors. Local economic conditions can impact liquidity needs. For example, a retailer in a region with seasonal tourism might need a higher cash buffer than one in an urban location. Why does benchmarking matter? It keeps expectations realistic. Say a manufacturing company has a current ratio of 1.5. On its own, that seems fine. But if the industry average is 2.0, it might signal inefficiency or cash flow issues. Comparing to others ensures better analysis of liquidity health. Cyclical industries and liquidity ratios. Not all industries behave the same way over time. Cyclical businesses, like agriculture or retail, face big swings in their liquidity because of seasonality. During peak seasons, cash and assets increase as demand rises. But in the off-season, these companies may experience tighter liquidity. Take a ski resort as an example. It might have a strong current ratio during winter months due to high bookings. By the end of summer, that ratio could dip, reflecting fewer visitors and lower revenue. The same goes for agricultural businesses, which may have higher liquidity post-harvest compared to planting seasons. How should you account for this? Analyze over the year. Don't just look at one ratio in isolation. Study trends over multiple quarters. Plan around highs and lows. Companies should adjust their cash management strategies based on seasonal cycles. Compare within the same cycle. When benchmarking, make sure you're comparing the same time frame. For instance, compare Q4 ratios of retail companies, not Q4 to Q1. Understanding these factors helps paint a full picture. Cyclical patterns and industry norms both play a key role in determining which liquidity ratios are strong, weak, or just plain normal. Skip the guesswork by carefully choosing relevant comparisons. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.